with you today. You get a lot more signals with this particular format that I will be sharing with you. So you'll have all the rules in their entirety today for strategy number 3A. All right, so why don't we begin? Remember, once again, for those of you who just may have joined us, if you have any questions, kindly wait till the end of the class. All right, so let's review. I know Bollinger Bands are very common. I would say everyone just about has used them or applied them or looked at them in their trading career. But for those of you who haven't, let's just go over a common review of what Bollinger Bands are. They're a very good indicator. I'm going to show you what the standard definition of them is. Bollinger Bands consist of a center line that's simply a moving average, a simple moving average, and two price channels. These are the trading bands above and below that center moving average. So you're going to see three bands. The middle one is just a simple moving average, and then there's one band on top and one band below. Now, when the markets become more volatile, in other words, when there's a lot of movement, these bands widen, or they move further away from each other, further away from the average. And during less volatile periods, when you're kind of in a range market or it's very quiet, the bands contract, or they move closer to the median average, okay? Now, the tightening of the bands is often used by technical traders as an early indication that volatility is about to increase sharply. So in other words, when you see these top and lower bands start to tighten and get closer to the median band, well, that usually is telling you that prices are contracting and you're going to start seeing some large movement within the market. All right, that's the conventional wisdom tells us how this usually applies. So if we look at an older chart here, we see that this is the way it applies. These are the Bollinger Bands, top, middle, bottom. And as we see at this point, this top band is coming lower and this bottom is coming higher. So they're contracting right here, and then it was subsequently followed by a large move to the upside. This can also work to the downside. As we see here, the top band was heading lower, and at this point, the bottom started to come higher. They're contracting, and then we all of a sudden had this large move to the downside. Now, this is conventional wisdom. This is the way Bollinger Bands are commonly used. There's nothing wrong with this. We feel it's a very good way to find out when volatility is going to return into the market. But we can't really rely on that in terms of actually knowing when to enter, when to exit, which direction is this move going to be. You see, at specialist trading, I like to teach all of my students things that are more cut and dry. We don't want to be so subjective where you just kind of basically say, well, there's going to be some volatility returning. It's up to you to decide where and how much and where it's going to go. So we want things that are a little bit more structured to them. This brings us to strategy 3A. This is the actual strategy I'm going to be sharing with you today. It uses the Bollinger Bands, and it has much more structure to them because we have a proprietary setting with the Bollinger Bands. So here's some of the highlights of this particular strategy. It's a continuation strategy. So we're not trying to buy pullback. We're not trying to pick tops and bottoms. We're waiting for some type of movement to start. We look for a little pause in the action, and that's our moment to jumpstart. That's when we jump into the market, and that's when we start going. So we're going to look at a continuation strategy. All right. Now, it uses a unique Bollinger Band setting. We're not going to use the same settings that is commonly in the default section of the Bollinger Bands. This particular strategy, this format I'm going to be sharing with you today, is designed to trade quick, powerful trends. So, oftentimes, when you use strategies, that you'll just gain a point or two, and sometimes you may do that with this particular strategy, but oftentimes you'll really find these tremendous, powerful moves because of the way the structure is applied. Now, you can apply this to any market, any time frame, any direction. So it doesn't matter if you're saying, well, I'm an investor. I don't really, trade short term. It's okay. I'm going to show you some weekly charts of how this can be applied just as easily. Or if you like to trade tick charts on the E-mini, all right? If you like to trade, 250 tick charts, it'll work just as fine. Obviously, the smaller time frame you have, you're going to get many more signals because you're increasing your odds because you have a lot more bars there. But that's still okay. It's up to you. You're going to learn how to apply this today, and I suggest paper trading with it first. As you see here, learn the strategy paper trade so that you can understand how to apply it, how it best meets your needs. Now, our edge here at Specialist Trading is consistency. What does that mean? Well, it means that we don't promise the world. We're not going to say that, okay, by using this strategy the way some other educators will tell you, you'll be up 5,000% by the end of the year, or you'll be buying a house or a car in a couple of months. We don't believe in that, and we feel that you should run if anyone says that. What we try and instill in all of our members is a sense of consistency, meaning 2 steps forward, 1 step back. That 1 step back means that from time to time you will have these small minor losses. But that's okay because of the consistency in all of our methods. Usually you bounce back right away, make back those losses, and then you go forward. So don't be worried if you're paper trading this and you see a couple of minor losses every once in a while, because oftentimes it will correct itself within the next setup and go forward. Okay? All right, so why don't we begin? Let's look at what standard Bollinger Band settings. If you open up whatever charting platform you're using, if you open up your edit box on the Bollinger Bands, you'll see that these are the standard settings once you apply Bollinger Bands to your screen. All right, a moving average, that's the middle band, equals 20. That's the default setting. And the upper band deviation and the lower band deviation are just +2 and -2. So what does this mean? It just basically means that that's the description of the distance or the deviation from the middle moving average. So the deviation is +2 to the upside for the top band. The deviation for the lower band is -2 for the downside, okay? That is your standard Bollinger Band settings, and once you apply them, this is kind of what they look like. If we plot them on a Facebook, an older chart of Facebook, these are the standard settings. This is what Bollinger Bands look like. All right, now we're going to share with you, usually reserved for members of Specialist Trading course, the Strategy 3 course, we're going to share with you the proprietary settings. All right, we're going to keep the moving average at 20. That's the middle line, so you don't have to change anything there. But we're reducing the size of the deviation of the bands, okay? Instead of 2, the upper band deviation is plus 0.382, okay? We've reduced it down to a fraction now. And the lower band, instead of -2, is now -0.382. So you may want to write those down. This is very simple to change. Just go to your edit box. You should be able to change the deviations of the bands. If you have trouble doing that, simply contact your tech support for whatever charting software you're using. They should be able to tell you how to change it, okay? And once you change the settings, this is what it should look like. You see how now we're looking at the same chart of Facebook, but now we have this much smoother way of looking. Instead of this contraction and then getting big again and just kind of, having these wide settings, now we have a much smoother kind of ribbon look to the Bollinger Bands, okay? So that's what you should be looking like once you change the settings. All right, so let's go over the rules step by step. They aren't really difficult, but remember, once again, if you have any questions, just kindly wait till the very end of class. Many times, if you have questions about these, they'll often be answered very soon. So just kindly wait, and then we'll go over them at the end. But we're going to show you a lot of examples, so you should be able to understand this by the end of the presentation. These are the rules, and we're going to start out with just going long right off the bat. All right, step 1. 5 consecutive price bars must close on or above the highest Bollinger Band. So in other words, it doesn't matter if you're looking at a tick bar or a monthly bar. You want to see 5 consecutive price bars, 5 in a row, that close either on or above the highest Bollinger Band. Doesn't matter which direction the Bollinger Bands are going. If they're going up or down, doesn't matter. Let me show you what that looks like. This is a 5-minute chart of the E-mini, but once again, this could be applied to a daily chart. It could be applied to a currency pair. It could be applied to a monthly or yearly chart. It absolutely doesn't matter. All right, as we see here in the beginning of this chart, here is the Bollinger Bands with the proprietary setting, how it looks a lot different, and prices oscillating above and then below. But at this point, when it closes above, we have a total of 5 consecutive closes above. Do you see that? Okay? That's the first step. You want to see 5 closing above. Obviously, if we're going short, you're going to want to see 5 close below the lowest Bollinger Band. But price must close. It's okay if the actual bar is, oscillating above and below and is penetrating. That's all right. We want to see the closes above. This is telling us that we have some sort of beginnings of a trend. All right, step number 2. Now we're going to look for a short-term pivot high to be created above the highest Bollinger Band. Or if you're not sure what a short-term pivot high is, basically it's in its simplest form, it's a 3-bar pattern where you have a high of a bar followed by a higher high of the second bar and then followed by a lower high of the third bar. All right, so if we want to expand that to 5 bars, it would look something like this. You see, where you have higher highs followed by lower highs. That's a short-term pivot high. So once we've located 5 bars that close above the highest Bollinger Band, then we want to simply identify that pivot high. And as you can see, that's right here. Now, the coincidence with this particular setup is that the short-term pivot high is within the 5-bar count, but it doesn't have to be. In other words, you can have 5 bars close above the highest Bollinger Band, but no pivot high created yet. And sometimes you may have to wait 2, 3, 5, maybe even 10 bars before you have this type of high created. So in this case, it's nice because it was created rather quickly. Oftentimes you may have to wait and just monitor it to make sure it does generate itself. All right, now step 3. Now that we've located this short-term high, we're going to enter to buy when price trades 1 tick above that short-term high that we just identified. Okay? So if we look here, we have the 5 bars closing above. We have this short-term high here, represented by this kind of little arrow. High followed by a higher high, then lower high. So we're going to enter if we trade right here. All right? So we have to wait and see what happens to price. And as you can see, price eventually traded 1 tick above. Now what you want to see is you want to see price remain above this highest Bollinger Band. You see how we got right down to it and then went back up? This is telling us that as long as price is above the highest Bollinger Band, we have some signs of strength happening here. So it's more ideal. Remember, this is the more aggressive version of this, but you want to see price stay as much above that highest Bollinger Band. All right, so once we went above this little short-term high here, this pivot high, that's where we entered. Now, how do we protect ourselves? Well, we want to place our protective stop below the lowest short-term low prior to entry. So a short-term low is just the opposite of a short-term high. You have a low followed by a lower low followed by a higher low. Now you create this kind of a V approach. So this is where we entered. Where was the most recent short-term low? It was right here. You see we have a low followed by a lower low, then a higher low. So you place your stop just below here. Okay? All right, so far we've entered the trade and we've protected ourselves. Now, where do we get out? All right, so now hopefully, we're going to get out with a profit, because obviously, if it doesn't work, we're going to get stopped out right there. But what if the trade goes in the direction we want it to go, which is up? Where do we exit? Here's the last step, and here's where people have the most confusion because it's applying a range extension. Most people are confused about what a range extension is. So we want to just simply sell on a range extension of either 200 or 300% and or 300%. It's up to you. Remember, once again, we want to put the power in your hands. So this is not a system. It's not saying that you always have to exit at 200. You can exit at 300 or you can exit at both. You can exit a portion at 200 or a portion at 300. Remember, these are strategies, not systems. We want you to decide how to trade this. That's the only way you'll be successful in our opinion. And by success, we mean consistent. We don't want you to just simply blindly follow something and not understand why. So let's explain to you exactly what a range extension is. Remember that short-term pivot high before we entered the trade? That was actually right here, remember? Well, that's the top of the range extension. And where did we start to go up? Well, right here. We were kind of going sideways and then price rallied from there. So where did the rally start? It started right here. And where did the rally first stop? It stopped right there. So that's our range. That's 100%. You'll always measure it from where the short-term pivot high was to where the rally started right here. So that's 100%. All right, so obviously then you take the amount of points. If you're trading currency pairs, it would be the amount of pips. But you take the amount of points and you simply double that. That's 200%. So this would be a place where you could exit right here if you wanted to exit at 200. Or if you wanted to, you could take that same amount of points and that equals 300. So had you used this simple technique on this 5-minute time frame here, in roughly about 3 hours, you would have had 17 points in the E-mini trading this method. That's relatively about $850 per contract. If you traded 10 contracts, you think you would have had a nice day there? And that's simple. We're not looking at any news. We're not relying on volume. We don't care about what somebody is saying in a chat room or a trading room. We're simply listening to the most important thing we should be listening to. And that's the chart in front of us. That's price. And that's it. We're using a few indicators to tell us how to apply some structure, and then we jump on board. See, our job as traders is just simply twofold. Try and figure out what the market wants to do, listen to the market, and then once we know what it wants to do, all we have to do is jump on board. That's it. It doesn't have to be more complicated than that. Trust me, from someone who overcomplicated their trading, my first 2 years of trading, I did everything you were supposed to do, listened to news, had tons of indicators, followed all the fundamental information, and signed up for all the newsletters, and I didn't make a dime. It wasn't until my mentors told me to just simply get rid of all that noise and simplify my trading and just use that two-step process, which is, listen to what the market wants to do, determine what it is, and then jump on board. Don't try to pick tops and bottoms, just simply go with what the market wants to do. So by the structure that we've given you, it's telling us the market wanted to go higher. It's above the Bollinger Band. We create this little stop here, and then once we went above that, we simply jumped on board. That was our trigger to jump on board. And now we just use this range extension as a technique to exit. Okay? All right, so that's it in entirety, the strategy number 3A. This is the more aggressive version, as you can see here, for capturing these big trends. Now, obviously, if you want to go short, because this will work going short as well, you just simply turn everything upside down. We're going to show you a bunch of examples, and then we'll go into the question and answer portion after that. So let's look at some more strategy number 3A examples here. And let's start out with stocks. We're all you stock traders. Remember, we can trade this in any market in any time frame. All right, here's an example of PSA coming into October. Here's the Bollinger Band with our proprietary setting. All right. We have roughly about 5 closes below here, which is giving us a proper setup to go short. But in order to go short, we would have had to continue to go lower, and we never did. So once we crossed above the highest Bollinger Band, then we start our countdown again. And we have 5 closes above the highest Bollinger Band. All right. So that's the trigger, and we want to go long if we trade above this short-term pivot high, which is once again within the 5. It doesn't have to be within the 5. Many times you'll just have 5 closes, a pivot hasn't been created yet, and you have to wait for one to form. But this one was within the 5, so that's our short-term pivot high, and we're going to go long once we trade above there, okay? Remember, we want to see that most prices stay above this, because this is telling us, remember, the market is telling us, not some guy in a chat room or not some guy on TV or not some convoluted indicator, but the market is telling us that most likely we have some strength because we're above that highest Bollinger Band. So as you can see, for all intents and purposes, we stayed pretty much above it, and that's where we traded finally above the short-term pivot high. So our entry is at 211.06, and we placed our stop just below the most recent short-term pivot low, as you see there, okay? So we entered here, and we place our stop here. Now we have to figure out where we're going to get out if we're right, because we know where we're going to get out if we're wrong. We already have our stop there. But what if we're right? What if the stock takes off? Well, we have to figure out what the range extension is. If we're going long, we go to the very top of where that short-term pivot was based on our entry, and then where did the rally start? Well, the rally started down here. That's where we first started to go up. So here's our range, 100%. And we can exit at 200 or 300. Now, if we wanted to exit at 200, well, we could have exited there. In a couple of weeks, we made nearly 12 points. Okay? See how simple this is? We didn't have to rely on any news. We didn't have to rely on any fundamental indicator or fundamental news or indicators or earnings. We just listened to the stock. The stock was telling you a month or two in advance that it was going higher. How about RAI? Well, once again, we are above above the Bollinger Bands, and we do our countdown. Here's 1, 2, but remember, we need 5 consecutive closes above, and as you can see here, we close below. So we negate this, and then we look at the next countdown. 1, 2, 3. We almost got to 4, but then this closed below. So we negate this setup. But now we have a total of 5 closes above the highest Bollinger Band. See, this is what you're going to have to do. Many times price will oscillate above and below, so you'll have to continue the countdown, and then delete it because there's no setup there, and then wait for another countdown. But there happen to be 5 closes now above, and there's our short-term pivot high. Okay, a lot of people would say, well, Steve, why didn't you use this short-term pivot high? Because at the time, this was only 4 bars. We hadn't had the 5th closing bar. We didn't know where this bar was going to close yet. So once we had 5 closing bars, then we find the first short-term pivot high, which is right here. So that's going to be our entry if we trade above here. We want to see these bars try and stay above the highest Bollinger Band. And 2 days later, we did. RAI traded there. It can be 1 tick, it could be 5 ticks. Once again, it's up to you. This is where you become a part of the process. Some of our students say, listen, if it trades 1 tick above, I'm in. Whereas other students may say, no, I want to see a little bit more confirmation. It has to trade 3 or 4 ticks above, maybe half a point. That's fine. There's nothing wrong with that. Where students get confused is they say, well, Steve, it doesn't have to close up there? No, the rule just states it has to trade there because as you can see, we didn't close above there. That doesn't matter. The close does not matter. All that matters is that we trade above the short-term pivot high. All right, so we traded above. We're in the trade. We entered at 45.30, and here's the most recent low right here. That's where we place our stop. All right, so we determine the range now. Remember, here's the top of the pivot high, and here's where the rally started. Here's where we first started to head and move it higher. So this is 100%. However many points that is, I believe it's about 3.5, 4 points. Then we simply double that, and in roughly 2 or 3 weeks, you could have made nearly 4 points just trading this simple technique. Okay. How about to the downside? Okay, let's look at R here. All right. Once again, price is first above the above the Bollinger Bands, and then it's below. But we have 2 counts here, and then we close below. Remember, we need to have all 5 bars closing above. So we'd have no count there. But as we look lower, we have 1, 2, 3, 4, 5. So now, what's the market telling us? Because we're below the lowest Bollinger Band, it's telling us that we're getting ready to have a move to the downside if we get a little bit more information though. All right? So where people can be saying, hey, this is a pullback, R is set to go much, much higher. You know, the earnings are going to come out. We don't listen to that. The only thing you should be listening to is the price. And the price is telling you most likely it's giving us clues it's going to be going lower. But let's see if everything else pans out. There's our short-term low right here within the 5 bars. Low followed by a lower low followed by a higher low. So it creates this type of a V here. But we can't enter the trade until we trade 1 or 2 ticks below. Don't have to close below, just have to trade there. So let's see what happened. Well, we did. We actually opened lower and closed much lower. So we're in the trade. We're short at 87.56. Here's the most recent short-term high. So we're roughly, risking 2 or 3 points. But where's our range extension? Well, remember, we take the bottom of where that short-term low was, where we placed our entry, and where did the sell-off begin? It began way up here. So this is 100%. Whatever the amount of points are, we simply take that amount of points, and now since we're going short, we subtract. There's 200%. So we're short at 87.56. In a couple of days, we made about 5 points. Now, if we wanted to go for an even larger move, we could have gone for 300%. And there we're making much more. Okay, we're making an extra 5 or 6 points to the downside. Now, what we tell our students is, in the beginning, you should just be trading with 200 or 300% range extension moves, okay? But if you really feel strongly that there's really a strong move in a direction, you can go all the way down to 400%. But that's for more advanced or more experienced traders, okay? The only thing we say is that at 400%, you should be totally out of the stock, whether it's going up or whether it's going down. You shouldn't be in any more than 400% because we've seen over time that that's usually where the trend will absolutely bottom out, such as in this case, you see it started to go higher, or top out if you were going long. So in the beginning, while you're learning this in paper trading, exit at 200 or 300%. Once you start to trade this and you feel a little bit more confident, you can exit at 400, but be out of your position entirely at 400. How about BCR? I show you this because this is an expensive stock, and a lot of people will say, well, Steve, how can you trade this for these big moves? Well, a lot of our students trade this strategy with options. It doesn't mean you have to actually purchase the stock. We know this is a close to $200 stock, so you could purchase the options for this big move. As you see here, here's the top of the short-term pivot high. We can't get through there. We have absolutely 5 closes above. So you would have entered, if you wanted to, if you decided to, on this bar where you opened up much higher. Now, a lot of our students would say, well, we're gapping up. I got an indication. I'm not going to buy it. But if you had options, maybe you'd want to. And you place your stop just below the short-term low, measure the range extension, and 200 and 300%. If you chose to get out at 300%, that's 19 points in just about 3 weeks. Okay, would have been a nice option play. In fact, here's an even better example: Amazon. Okay, this is a recent chart into this month. I believe this is just coming in the last couple of days. We had a series of closes above the Bollinger Band. So right here, with no other information, you may have thought, well, we're getting ready to go higher, but we closed below. So everything changed. Then we had 3 closes below, but then it closed higher again above the Bollinger Band. So now that's negated, and we're not going to be going short. We need 5 closes either above or below. But now we continue to count, and now we have a total of 5. So this is telling us that most likely we're going to be going higher unless we start to close below the highest Bollinger Band, which we didn't. So here's our short-term pivot high within the first 5 bars. And you could have used this once again to purchase options. And in 2 weeks, this was roughly coming into this last week, I believe it was on the 26th, Monday, the stock gapped up, and you could have had a 66-point gain. So remember, obviously there was some news why this stock gapped up on the 23rd or 25th, where it just went straight up. We didn't know that 2 weeks ago. The only thing we listened to was the market, the stock itself. We don't follow news events, we don't follow earnings, we don't follow what's going on globally, because once you learn to listen to the market, it's a lot easier. So the market was telling us way back here at the beginning of October, we're most likely going higher as long as all the structure is met. And once you would have entered, you could have purchased options. We know $500 stock is very expensive, but it would have been easy to purchase options and a nice 66-point gain. All right, now this can also work to the downside. Here is coming into September. Tiffany, we see here that we're kind of oscillating above and below. And now we had 1, 2, 3, 4, 5 closes below. And here's our short-term pivot low. 2, 3, 4, 5, excuse me, right there. Here's number 1 count. So here's our short-term pivot low. You enter here at 88.37. And in a couple of weeks, in the beginning of September, you could have exited for a 7.5-point gain to the downside. Okay? So it works in any direction with stocks. In fact, you can apply this to commodities. Here's soybeans, okay? This is a chart in soybeans. Same principles apply. We're not going to change anything because we're going now to commodities. We're looking for 5 bars to close either above or below. Nothing is happening until right here where we have a total of 5 bars, okay? But we still don't have the short-term pivot created until right here. Here's on the next bar, the next 2 bars, we have that. So we would have entered right here at 974. And roughly about a 60 basis point gain here in just a couple of days in soybeans. That's at the 200 range extension. That's soybeans. What about crude oil? Remember, crude oil was really falling out of bed in the summer months. A lot of people were saying, well, it's got to bottom out. It's got to bottom out, and if you tried to buy crude oil, you would have lost a lot of money. Isn't it a lot easier if you just simply in sync with the market? The market told us way back here at the beginning of July, we had 1, 2, 3, 4, 5 closes below. So actually before July, this was in June, it was telling us we're most likely going lower in crude oil. Forget about what's happening globally within the world. Forget about economics. The market is telling you it's most likely going to be going lower. That's the only thing we need to listen to. So anyone trying to buy crude oil based off some economic news or fundamentals would have lost a lot of money this past summer. A lot simpler just to use this proprietary setting and then look for the first short-term pivot low, which was here. Okay, so you had 5 closes, but you had no pivot low until this point. Now you just apply the exact same rules. Could have entered a 52.28 to go short, measure your range extension, and at the 200 range extension, you have 11 points. You've basically made 11 basis points going short. Okay, and it was a good thing if you covered at the 200 range extension, because that's when price started to go higher. So this is why we always suggest that it's up to you how you want to trade it. But what we suggest many traders is to take some, especially when you're beginning, take some off the table at the 200 range extension and then move your stop to unchanged. So therefore, if you have multiple positions, you can sell half here and then maybe you sell the other half at 300 or possibly 400. But all the time as you hit these other levels, move your stop to that level for the remaining portion of your position. Now that's in crude oil. Let's look at the E-mini S&P, because as I stated, this works in any market, in any time frame, and in any direction. So far we've just been looking at stocks. Let's look at the intraday trading of the E-mini. Now, here's a 2,000 tick bar chart of the E-mini, okay? As we see here, this was on the 23rd. If we look here at the very bottom, so this was just this past week, last Friday, not even a week ago. We had a total of 5 closes on this tick chart below, and here was our short-term low. So if price would have gone lower, we would have been short the E-mini. So that's all we needed to know. But we never went below that low, so we waited for price, and it went now above the Bollinger Bands. We simply count 5 bars, and there's our 5 that have closed, but we have no short-term top created yet until right here. So that's our short-term top. So what we want to do is we have perfect setup, but we still have no confirmation that we're entering the trade yet. So we haven't bought yet. We're not going to just simply buy at the market. We want to see that price stays above this high Bollinger Band, and we want to see that it trades above this short-term high. And that's going to be our entry. As you can see here on the very next 2,000 tick bar chart, it did. So we entered this trade at 2063.50. We placed our stop roughly about 2060. So we're risking 3.5 points, not even a couple $100. And now the next thing we do is we have to calculate where we're going to exit. So we take the top of that short-term high and where the rally started down here. That's our range extension. There's 100. We simply take 2 and I would say roughly we entered around, let's see, 4:15. This is a overnight chart, and prior to the opening. So this is how, we have a lot of traders who trade in the overnight markets, or different countries who trade on different time schedules, but they like to trade the E-mini overnight. This happened prior to the opening in New York, or in Chicago, I should say. So you made nearly $500 prior to the opening of the day. This is the beauty of this. So a lot of traders are always asking, can we trade this in the overnight session? Sure. You see right now here how it worked well. But let's look at the regular session. Okay, here's a chart, a 60-minute chart of the E-mini as we see here. We're still looking at the overnight session, but this is a trade that happened on the 28th as we see here, and it happened on the 28th of September. And this was just in one day. All right, this is an hourly chart, and we have 5 closes, and we have a short-term bottom. So this is where we're going to enter. But we never entered because we never traded below there, and then price started to rally, and guess what? It closed above the lowest Bollinger Band, so the trade is negated. We have no setup. We're not going to wait and say, well, if it goes down there again, I'll get in. It may have worked out, but that's not the way we trade this strategy. We have to wait for a completely new and different countdown. Well, lo and behold, we got one. 1, 2, 3, 4, 5 more closes below that Bollinger Band, okay, as you see here. And within the 5, we had a low. So that's our entry point at 1902. You could have entered roughly about 7 a.m. Pacific time. And by 9 a.m., you had 27 points, okay? I mean, that's like $1,300 per contract. Imagine if you had 5 or 10 of these contracts. This was on the 28th, just about a month ago. Let's look and see what happened on a 5-minute chart of the E-mini. This is on the standard time, and this was, I believe, on the 15th. So this was just about a couple of weeks ago on the 15th on a 5-minute chart. Looking at this, we see that we had 5 closes below the lowest Bollinger Band. So this was a perfect setup to go short if we had traded below this low here. But we never did, so there's no setup. So we wait for price, and it trades on or above the highest Bollinger Band. So now we have a setup to go long. We find the short-term pivot high, which is right here. You would have entered at 1998.75. Remember, this was just less than a week ago or 2 weeks ago. Place your stop roughly around 1996, and so you're risking 2 or 3 points, roughly about $100, $150. And you measure the range. Here's where the rally started, and here's where the short-term pivot high was. That's 100%. You simply double that for 200 and triple that for 300. So there's nearly 1,800 points, or nearly $900 in basically just about 3 or 4 hours work just trading one contract. Okay. We didn't care. A lot of people say, well, yeah, because the market really got an influx of a lot of institutional investors. There was some good news that came out about interest rates or jobless claim. We don't look at that. I mean, why overcomplicate your trading when all you need to do is look at this? It's too subjective. I mean, I heard people today complaining about earnings that came out yesterday and how the stock didn't react favorably. And there's too much discretion involved. I'm sure a lot of you have had instances where you purchased a stock or got involved in the market because of some fundamental news, and it worked, and the news came out exactly the way you had pictured, so you're all set to go, and the market reacts the exact opposite way. So, why put yourself in that position? It's much easier to let the market tell you what it's going to do, all right? Don't try to figure out what's going on with news or with tons of indicators, because that, in my opinion, is a recipe for disaster, and that is why upwards of 80–85% of all traders fail. So the market was telling you, at this point right here, I'm going to go higher. Our job is just simply to jump on board, add a little structure to tell us when to get out, and that's it. So we roughly would have, in this 4 or 5 hour trade, risk about 3 points or $150 to make nearly 18 points or nearly $900. Okay. Now let me show you something that happened yesterday. This is to show you that we're not cherry picking the best trade. This happened yesterday right before the close in the last hour of the day. Now obviously if you trade larger time frames, you have more profit potential. But this is on a 1 minute chart in the last hour of the day, as you see here coming into the 28th on the far right hand corner, which is today. Now we were oscillating below, above, below, but we never had 5 closes until this section right here, where we wanted to have 5 closes either on or above the highest Bollinger Band. And we did. We had 5 closes right here. We created our short-term pivot high, kind of a double top right there. So that's our point of entry, all right? But we have to trade there and try and stay above. We can close on the way we did right here, but we don't want to really close below, because that'll tell us that the market is giving us signs that we're kind of running out of steam here, most likely going lower. So on the very next bar, what do? We actually traded above there. So that's our entry point. So yesterday, roughly at 10 minutes after 12 Pacific time, roughly about 50 minutes before the close of the market, or roughly about an hour because the market trades till 1:15 Pacific time, you could have entered at 20.56.50 and placed your stop right here at 20.55 roughly. So you're risking about 100 or 1.5 points or $75. Now you simply measure the range extension. Here was the top, and here's where the rally started. That's your range extension. Here's 200 and 300. Once again, it's up to you to decide where you want to get out. If you're trading maybe 3 contracts, well, maybe you'd want to sell 2 at the 200% and maybe let all 3, or except, the last third exited right here. Or maybe you'd say, I've been doing this for a while. I really think we're going to have a strong rally. I'll exit everything up here at 3. So it's up to you. But as we can see here, we entered at 20.56.50. You would have exited a portion here at the 200 and a portion here at the 300. So you made 4 points. That's roughly a little over $200 per contract in roughly about 45 minutes, and you risked $75. So that's a pretty good risk-reward ratio. And this was yesterday, not even 24 hours ago. All right, let's look at the Forex markets. Lastly, for all you Forex traders out there, we've looked at tick charts, 5-minute charts. We looked at daily charts. We looked at soybeans, crude oil, stocks. Now let's look at the Forex markets on a weekly chart. Here's the Australian dollar. As you can see here, we're originally above the highest Bollinger Band. In fact, we had numerous closes above. We had a short-term pivot high, so we were all set to go long. And this was going back, since these are weekly bars, this is going back to 2014, about a year ago. But we never went above the short-term pivot high. So there was no trade there. And we oscillated below, kind of closed back up above until here. We had 5 distinct closes below the lowest Bollinger Band. So what is this telling us? Forgetting about global economic news, forgetting about what the Australian dollar is doing, the market, the chart is telling us we're going lower on a weekly time frame. All right? So we have to just get a little bit more confirmation, but the market is basically screaming to us, forget about all this noise and just listen to me. I'm giving you clues that I'm pretty much going to go lower. So all we need to do is find that short-term pivot low, which is right there. And if price trades below there before it goes back up above, we're going to enter to go short, which it did. You would have entered roughly around November, which was just about a year ago, at 86.41. Here's where the low, the short-term pivot low was prior to entry, and here's where the sell-off started. That's 100%, and there's 200% and 300%. So you could decide where you wanted to get out, and had you taken the 300%, well, this last month actually, or September, you would have had a total of over 1,500 pips. That's $15,000 per lot, okay? Right now, everyone has an excuse and a reason and justification for the Australian dollar going down. You don't need to rely on that, because by the time you figure out why it went down, it's too late. All you have to do is look at the chart. So we showed you tick charts where the same rules apply. We showed you weekly charts right here. We showed you daily charts. We showed you commodities, currency pairs, Forex, stocks. This works on any market, any time frame, in any direction. Now, let's recap before we go to question and answer, okay? Remember, this is a continuation strategy. So we're looking for a sign that the market is going in our direction, a small move either to the upside or to the downside based on our unique Bollinger Band setting. And then we're waiting for a little pause in that movement, and then we're jumping on board. Similar to a train that comes into the train station. We wait for the train to come in our direction. It kind of stops a little bit. We jump on board, and then it resumes its move. That's what we're doing with this strategy 3A strategy. It's designed, as you saw here, to trade quick, powerful trends. It works in any market, any time frame, any direction, as you just saw with many of the recent charts I just showed you. But please learn this strategy first, paper trade. I'm not going to sit here and tell you that every trade works. So you have to really get a feel for it. Most often, our beginning members lose because they trade the strategy faulty. They don't follow the rules perfectly. They get too excited and they enter at the wrong place, or they measure the range extension improperly, or they place their stop at the wrong place, and it results in losses, and they say, well, this doesn't work. And then when we go back and review, they see that they were implementing the strategy incorrectly. So paper trade it so you really fully understand the rules, and then you'll get that consistency in your trading. Now, before we close, I'd like you to ask yourself a question, and I want you to ask yourself honestly, do you think any of these edges I just shared with you could have helped your trading this past year? I know a lot of people at the beginning of the year always have all these goals and promises they make to themselves of where they want to be towards the end of the year. Well, we're getting right close to the end of the year. We've only got a couple of months left, and I can almost guarantee that most of you have not met your goals, because that's just the way trading is. Most people build their foundation off faulty information. I know I did when I first started trading. So do you think this could have helped your trading this past year, even if you just used or applied a couple of those techniques, such as the range extension exits, or looking at the unique Bollinger Band setting? Well, here's what we're offering you today to get your trading back on track for the end of the year and hopefully for the beginning of the year as well. We're going to offer you our Strategy 3 Trend Trader course. Now, you just learned Strategy 3A, the real aggressive version. Strategy 3 Trend Trader course actually has 2 strategies involved in it. We're going to give you 2 courses for the price of 1, and we're also going to give you a special attendee discount. Now, Strategy 3 is a pullback strategy.